Mahesh Patil joins us. Let's connect with him. Mahesh, good morning. Thank you for joining us.
Yeah,
Uh,
good morning.
Mahesh, how would you characterize the current market for us? One side there is intense selling by FI, other side there is strong buying by DII. But the problem is the middle layer, which is the HNI, ultra HNI, retail crowd, which seems to be panicking now.
Good morning. So I think if you look at the market on two aspects, right? One is on the fundamental construct, if you look at, right? So there has been earnings slowdown. We've seen the momentum, okay, which was there on the earnings side or in the economy that has slowed down in the last 2 quarters. And there also after a long period, we have seen now that there has been downgrades to earnings, right, which has been there. So that is something which is on the fundamental that I think will probably continue for the next couple of quarters or so. And on the liquidity side, if you look at, right, you're right. I think FIs have been selling. Again, probably it's not India selling per se, but overall outflows from emerging markets, okay, which we are seeing because of the dollar strength, okay, which is resulting into the correction over here. And I think post the recent sell-off, I think the markets, at least in the large cap space, are now looking fairly reasonable. So I think the complaint which FIs had about India being expensive, I think to some extent that gets corrected, and they might come in as things normalize on the global front. Domestic flows are still fairly strong, but I think the retail money which is there, I think that is probably still could get impacted as the market breadth continues to weaken, and that's I think is a slight worry, which might mean that the market could remain slightly depressed, where the Nifty might probably correct a bit, but the broader market, the mid cap and small cap, can continue to correct in this kind of market environment.
What is your understanding about the kind of flows or the kind of cash which is gone? What does MP mean? I have no idea. Okay, we'll just, HUL is down 4% now. And the earnings impact, I think, is very evident in the way how things are moving. So wherever there is bad news, that stock is getting slammed. Wherever there is, all right, he's back. So Mahesh, what is your understanding about how much cash mutual funds currently have? And, I mean, everybody is now trying to understand that how long this FI selling will be digested, or how much more ability domestic funds have to absorb this 3,000-4,000 crore of FI selling on a daily basis.
So I think the overall cash levels, I would say, for the industry would be somewhere around, on an average, around 4 to 5% in that range, which is pretty reasonable. We have also seen that some of the funds, because of the market indicators, a lot of these balanced funds which are there, the balanced advantage funds, okay, which are also running currently low on equities, say around 40-45% or so. So there is room for them to deploy that cash in case of a market correction from here. I would say that the overall cash in the mutual fund would somewhere be around 1.5 lakh crores or so. I think which is still reasonable, okay, to continue with the FIS selling, okay, which is coming in. But I would guess that the FIS selling, what we are seeing currently, probably I think after, I mean, we've seen now Trump taking office. I think the policies are now getting clear. So I think the initial sell-off because of the uncertainty, I think that should kind of wither down now. But yeah, if the onslaught continues, I think you might see this cash levels, okay, kind of dwindling. But on this other side, I would say the inflows, domestic inflows are still fairly strong, right? So we are still seeing around roughly around 35-40,000 crores from domestic mutual fund inflows. And if you look at the PF money which is coming in, so I think that is still fairly steady. We are not seeing that getting impacted. So I think that should kind of balance out the FI outflows, what we're seeing.
All right. Hi, Mahesh. This is Shrishti also joining in. But Mahesh, in this environment, we are seeing that the high PE stocks are getting punished even more in some of the slightest negative news that these companies come up with. So do you believe that we are entering a phase where these valuations could normalize a bit? And this is the new regime we are entering, where we once again sing the song that valuation matters.
I think we are currently getting into a phase or a regime where interest rates, at least globally, at least in the US, have again risen up. Okay, so there is some risk, at least in the short term, for them to further move up. And liquidity is getting tighter, right? Global also liquidity is getting tighter. In India also, we've seen that while the RBI has tried to take measures, but because of intervention in the forex market, the liquidity is still fairly tight. So both these conditions are normally adverse for any high PE stock or high growth stock, right? Where you're looking too much into the future and discounting that. And that is what is seeing a correction. Also, with growth slowing down across the board, some of these stocks are getting more hammered. So I think the one-way rally, what we saw in the market, right, 2-3 years back, I think that is now clearly behind us. We'll see choppy market, and this period, any slight disappointment in earnings, and especially in companies where the valuations are significantly higher than their long-term average, I think there is risk, and that's what we're seeing it playing out in the last couple of months.
All right, Mahesh, but the topic of slowdown that you were just highlighting, yes, indeed, there's a short-term slowdown, particularly in some of these cyclical sectors. But in such a down period, the policy intervention becomes even more critical. So on that front, what should actually the government could take steps in terms of the policy support that could be most effective to reverse this downtrend?
Yes, you're right. I think we still believe that the slowdown, what we have seen is a short-term cyclical downturn. Again, to some extent triggered because of the large fiscal contraction. Okay, what we saw, negative fiscal stimulus in the first half because the government spending was lower. Also, the RBI was running a fairly tight monetary policy. We've not seen any kind of easing. But I think on both this, I think to really come out of this situation, I think we'll need help both from the fiscal side as well as from the monetary side in terms of improving the liquidity first, and then cut in interest rates, which we think now there is a good probability of that happening in the Fed policy. Also in the budget, while the government has continued on its path for fiscal consolidation, and I think they might still continue with that because they are looking at, I mean, the whole idea is to get the whole fiscal under control so that you can look at a rating upgrade somewhere at the end of this calendar year. But I think there is some amount of short-term, I think up till now, the government policy on the budget has been towards long-term growth, trying to invest on the CapEx, which is the right thing to do. But I think a short-term stimulus and boost is required, I think, so that balance of getting short-term growth and long-term growth, I think, needs to be really tackled in this budget, okay, for us to come out of this kind of a slowdown.
Mahesh, where do you think excesses in the market have still not corrected?
So, I mean, excesses in a few of the high growth sectors, if you look at still, like, for example, sectors like EMS, right? We've seen, again, a very high growth sector, a good potential, but again, there could be challenges. I think if some of these, because the assumptions of growth are really, really high over there. So that's one sector where we think it is still on the higher side. Apart from that, capital goods, industrials, they're also, I think, if you compare that sector vis-a-vis the historical, they're still on a much higher level. The valuations are much higher. Again, you cannot argue that in these sectors, the outlook in terms of the growth is still better. But in the current slowdown, we're seeing some slowdown in the private sector capex also. So I would say industrials, the EMS sector are some of the sectors where the valuations are still frothy. And apart from that, I would say that we've seen now a reasonable correction, I think, across some of the stock. In fact, while the index is not, there are many stocks now which are down 30-40%. So clearly, I think the market is a kind of a divided market, right? There is now value emerging in a few stocks, and we think that it's going to be more stock specific this year, right? We had seen those broad thematic rallies in the last 2-3 years, big sectoral moves. I think this year is going to be more stock specific rather than betting on any particular sector.
Is the best behind some of these consumer tech and fintech stocks?
I would not say so. I think there is been some correction. As I said, we've seen a correction in some of these high growth stocks, slight probably a competitive intensity in some of these companies has elevated. But I think these are companies where some of these spaces where the structural growth drivers are very much in place. In some of the cases, the unit economics are still in place. There's a short-term burn because of the competitive intensity. So I would say that this is a sector where in this correction, again, can be a good level to look at for somebody who's willing to look beyond the next couple of quarters and taking a slightly longer term view. So I would say that the long term story of disruption and gaining market share, the overall time, I think those constructs still remains in place.
Okay. Mahesh, in the light of US strength, and I'm assuming that US strength is real, the high frequency data is strong, the dollar is real, do you think it's time really to align with exporters? We've seen outperformance in IT, we've seen outperformance in pharma. Do you think that really could be a 6-month more outperforming trade?
So I think we'll have to see, because see, on one side you're talking about US economy. I think the policies what Trump is doing will be good for the US economy, so that should improve the trade. But at the same time, there would be tariffs, okay, which could be levied. So I think we'll have to see in which sector or how that plays out, because that could, while India might still not be at the receiving end to that extent of what other countries would be, but that needs to be looked into. But by and large, I would say sectors like IT, for example, right, where the sector A, there is some tailwind again for the exporters. Also, there is a tailwind from the rupee depreciation, which is that we think the rupee is slightly still overvalued. There is still some room to depreciate by another 3% or so from here. So that could be a tailwind. But I think the sectors like IT and pharma, I think would be a better place. They're more defensive in nature, where the growth trajectory anyway is steady. In fact, IT is coming in from a kind of a slowdown, and we're seeing the commentary in this quarter. If you look at it's slightly better, and they've been able to protect their margins fairly well even in the growth slowdown. So and again, the US is again talking about big spending on tech. So I think IT and pharma would be a better place to play the whole rupee depreciation and the export play.
All right, Mahesh, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us. Great chatting with you.
Thank you.
If you like this video, then like, share and subscribe to ET Now.